Today I'm going to talk about when you should switch one investment for another in your portfolio. Hi, my name is Gary Mishuras. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. I also teach the Value Investing Seminar at the F.W. Olin Graduate School of Business. So let's presume that you have a portfolio and you're fully invested. You don't have any cash. And presumably every investment in your portfolio is currently undervalued, right? Because, otherwise why would you own those investments if they were undervalued? And a lot of times when we buy something, let's say we buy something at some discount to intrinsic value, that's a part of our margin of safety, and then it goes up in price, but not quite enough to the point where we're ready to sell it. And let's say another investment comes about you considering, and it's attractive. You would normally make it if you had cash, but you don't have cash. So now your choice is, do you pass on making this new investment, or do you sell one or more of your existing investments in order to make this new investment? So that's the situation that we're talking about, and that can be tough because on the one hand, hey, you found some new exciting investment that's attractively priced and you want to make the investment. On the other hand, you really don't want to sell anything right now. So what do you do? So I think there are two dimensions to think about. The first dimension is the quality dimension, and the second dimension is the discount to intrinsic value dimension. So along the quality dimension, you should think about what would you have to sell and the quality of that versus what you're buying. So in my kind of investment approach that I explain in the owner's manual, I give businesses a rating in terms of quality 1 through 5, 1 being best, 3 being average, 5 being worst, and 2 being above average, and 4 being below average. It's not to say that there's only 5 levels of quality, but it's a way to kind of categorize businesses into kind of buckets of quality. So I would say if you have a 1 or an excellent business, the highest quality business, and you're thinking about switching into another more undervalued, also highest quality business. That's kind of an apples to apples comparison. So let's look at that first. So the way I think about it is, let's say that the investment you're considering selling in order to generate the funds you need to make the new investment is trading at 80% of your base case value, or 80 cents on the dollar. And that's probably the kind of typical level. Let's say you bought it at 65, 70 cents on the dollar, and it appreciated a bit, but not quite to the point where the price to value gap has closed. So how cheap does this new investment have to be relative to its intrinsic value for you to make the swap? So I think a simple way to think about it is, let's say, so in my case, I would want right now to pay no more than 65% of intrinsic value for a new investment. So let's say that that's my threshold, and if I were paying with cash, I would be paying with 100-cent dollars. But you're not paying with cash because you're paying with an undervalued currency. So you're paying, for every dollar you generate by selling this 80 cent on the dollar investment, you're giving up the fact that it's worth not 80 cents, but in your view, it's worth $1. So one simple, way is to set the threshold at whatever your normal threshold would be, multiplied by the cents of the dollar, or the percentage of intrinsic value of the new investment of the old investment that you're selling. So let's say if you're selling the old investment and your threshold is you don't want to buy anything that's not at least 65% of intrinsic value or cheaper, then if you're using 80-cent dollars, you would want to have a threshold of about 50 cents on the dollar as the new level of cheapness, because you're taking into account the fact that you're using basically a undervalued currency of selling an undervalued investment to fund your purchase. So that's pretty easy. What about if investments are of different quality? And there it gets a little tougher. So is it better to have a moderately undervalued excellent business, or is it better to have more undervalued good business, or really, really undervalued okay business? I think there's some judgment there. I would say in general, I would caution you against selling really good, really excellent businesses to buy mediocre businesses, irrespective of how cheap they are. Assuming that the really excellent business you own is still undervalued. It just really infrequent that you get really excellent businesses to be mispriced. You are far less likely to make an error in valuation for a business of that quality, and to use the proceeds and kind of cut the investment short just to buy a mediocre business that's really statistically cheap. I would say, something's got to be really compelling, and I would mostly stay away from that. But let's say if you wanted to switch from a really excellent business that was just a bit mispriced to a business that was a good business but not quite as excellent, I would say, again, just use the same math of whatever your threshold was for the purchase of that new business, and multiply that by the price to value of the investment that you would be selling, and that would be the new level of undervaluation that you would require to buy a new investment. So again, I know this is can be a little bit tough to follow the numbers, but the basic idea here is when you're fully invested, you really want to take into account the fact that if you're going to buy something new, it needs to be more undervalued than it usually would be, because you're not using cash, but you're selling a undervalued investment to fund that purchase. So you need to figure out some way of saying how much cheaper than normal would I require this potential new investment to be in order to buy it. And the way I outlined is simplistic, but it gives you a logical approach to thinking about this question. If you like this video, please hit like and subscribe to my YouTube channel for more educational content on investing. Thank you, guys.